You are listening to ChartingWealth.com for Tuesday, the 9th of August, 2016. We are jumping in, as we always do, starting with IYY, which is the iShares Dow Jones U.S. Total Market Index Fund. Tracks the whole market, which was up just barely at 0.01%, 0.1% for the day. The candle on the 8th ended that 2 days, and we have a green up candle after two prior two-day candles of down movement. If we look at how the movement played itself out during the day on the 4-hour chart, we can see, as we talked about for our Monday podcast, that crossed over going up in the afternoon on Friday. Those of you who were brave may have found an entry point on the morning of the 8th. We saw up movement in the morning, and then, of course, a burning off in the afternoon, so that it was just barely up for the day. Again, the kind of candlesticks we use are the Heiken Ashi. You can find more about those at our website and on YouTube. We have a great training that is available. Also available for those of you who follow us on iTunes at the Daily Podcasts website. Remember, we have a video weekly podcast and the daily audio podcast. You can find our training on Heiken Ashi there also. Heiken Ashi means average pace in Japanese. We love those candlesticks. Much easier patterns, much more accurate, we think, for the kind of trading and investing that we do. We did see, as I spoke of earlier, on Friday afternoon, the 5th, there was a crossover going up on the charts on the total market. Now, again, the markets were not up on all of our other charts for the day. Gold was down, as was the S&P 500 and the NASDAQ 100, the tech stocks. But the total market squeaked up just a little bit. Again, let's now go back to our 2-day chart and check out the S&P 500. It was actually down 0.06% for the day, although we do see a green up candle ending. Again, it's a 2-day chart that takes into account Friday's up movement and then the down movement on Monday. That's why we have a wick on top of the green open box candlestick after two solid red down candles. We see the derivative oscillator continued to lose energy. However, the MACD and the signal line stayed apart, which is always a good sign. If we look at what happened during the course of the day, of course, those of you who are paying attention may have jumped in on those trades on Friday afternoon after we had the crossover following the morning up movement. We saw that on the 4-hour chart, the derivative oscillator and the MACD crossed over at virtually the same time. Always a good move. Of course, we are concerned about the market topping off, but hey, we trade by the charts, don't we? We are active. We are also lithe and ready to move in and out of markets when movement is dictated. Again, we do have some concerns as we continue to see the market hit about the same mark. It's a little above where it was back on the 15th, but not much. It's been sliding sideways a good bit, and we do see the derivative oscillator on that 2-hour chart losing energy each day. So if you did get into that move on Friday, be very careful. Be ready to take your money and run if the market does move against you in the next few days. Now, let's go from the S&P 500 to the Qs, the NASDAQ 100, and it has been a beautiful chart, but for one drawback, we had an open box red, which means indecision. That happened on the 4th, that 2-day candle on the 4th of August, but literally since the 29th of June, the 1st of July, we have seen up movement, just smashing it out. We had the crossover on the 11th of July and have continued to see this market move up. Now, and for the record, the Qs was down on Monday, 0.11%, but we do have a green open box candle because it's a 2-day candle and it reflects all of the up movement on Friday. Now, if we look, what do we see going on? Well, we saw the crossover occur in the morning on Friday. Those of you who are looking to get back in, we did give you some caution because we've had a number of entry points all the way back on the 20th. We had a crossover entry point. That is the 20th of July. We had another crossover entry point on the 29th. All of those have paired very well for you, continued to move up since those dates. Also, for those of you who are looking to enter even earlier, or not as safe as waiting for the pullbacks and then the crossovers going in the same direction as the movement. If you don't quite know what we're talking about, go to the website, listen to chapters 1 and 2 of our book that we've already put out. We explain some of that. Also, if you sign up for our daily newsletter, we will send you daily this charting review. With that, we send a link to our How to Read a Stock Chart video, which you've got to have. That will cue you in quickly in about 12 to 15 minutes exactly what it is we are trying to do here every day. It is not complicated. We keep it simple because to trade and do it well, we believe you have to keep it simple. If you don't keep it simple, you're going to be stupid. Now, let's, as I was talking about, when we saw some pullbacks that was red candles, some of you were jumping in after the pullbacks on just the candles, and that has fared you well with this continually up-moving market. We did see the market end the day with some real indecision. So again, pay attention to what you see going on these charts. Remember, the short chart does not control. The short chart is your entry chart. The chart that sets your tone is, of course, your 2-day chart. And as we talked about, if you haven't listened to it yet, the weekly review and forecast, you need to, because we cover what's actually happening with the weekly chart. Because remember, all things being equal, the charts tend to move in the direction of the biggest chart, which is the weekly chart. Now, enough on lessons there. Do pay attention. Those of you who have been in since early on these cues have seen them climb and make you really, really incredible returns on your virtual account. I say virtual account because we do not give trading advice. We're an education firm. You see that caveat in everything we put out. We want you to be with us, learn how to trade these charts, set up your own account, an online account, a virtual account at any of the online brokers, and start practicing with us every day. Fill out your daily market worksheet. Follow along with us as you do that. And as you start being able to call these on your own, as you're able to enter into investments and or trades and get out with profits, and you get better and better at it, at some point you can make up your own mind to make up your own decision to go out and invest as you see fit. But we are not a stock calling service. We're simply an education firm. We want you to learn how to do this. Then you can make your own calls. Now, lastly, we are going to, on our 2-day chart, go to gold. What is gold doing? Well, gold crossed over going down on the 8th. That candle ending, then we saw gold really plunge down on this last 2-day candle. Big down day on Friday and another down day for gold, 0.09% on Monday. And we are now in a confirmed down pattern on the big chart on gold. Now, if we go to our 4-hour chart, what do we see going on? We see yet again that our 4-hour chart is becoming almost a complete trading chart for us, isn't it? When we start looking back, as gold starts trending, the chart that we have is a phenomenal chart on just the 4-hour. When you see it cross and our chart is really working, it stopped working at the end of the year when gold started sliding sideways. Prior to that, it looked like the chart I am looking at now. When it crossed over going down, it was hard not to make a good buy in gold. We see that all the way back. Well, let's see. We see it all the way to the 3rd of June. You could have gotten in and ridden it up very nicely. When it crossed back over going down, you could have done an inverse in gold around the 20th, and you would have seen it ride down nicely. You could have crossed back over with gold around the 24th, ridden it up very nicely, and then ridden it back down in an inverse fund around the 11th of July. And it went pummeled down quite well, and then crossed over going back up again on the 27th of July, and then crossed over going down on our 4-hour chart on the 5th, and continued to move down. So we are getting to where we are trusting our 4-hour chart again. People always say, how long do you believe in a chart? Well, you believe in it as long as it's working. And charts are apt to change, particularly when you use the MACD and a market starts sliding sideways. When you don't have a lot of movement in the MACD, it loses its effectiveness. And it really did that to us toward the end of the year, last year. Now, let's go back to our 2-day chart on gold. And again, just realize that charts always, as we've said before, tend to move in the direction of the big charts. We have 2 big charts. We have our double long, which is the weekly, and the long chart, which is the 2-day. We use our 4-hour chart for our entry chart on almost all of our other indexes. We really appreciate you being with us. When you have questions, problems, concerns, hey, go to Charting Wealth. Let us hear from you. We will try our best to answer your emails in a timely manner. You need training, you can find it at our YouTube channel and, of course, on our podcast and at chartingwealth.com. We really want to encourage you to please help us out by going and subscribing to the YouTube channel. Once we hit 1,000 subscribers, and we're getting closer every day, we're about 858, something like that. So we're less than 150 people. Once we hit that 1,000 subscriber mark, we can start providing you, our subscribers, with proprietary broadcasts. We get thousands that listen every week, but those 1,000 hardcore subscribers are required by YouTube for our proprietary broadcast to start. So please help us out there. Additionally, if you appreciate what we do, subscribe to us at iTunes. You've gotten us as high as number 6 in the world for stock market podcast, and we want to keep growing and sharing this information, helping people understand that you can read these charts. They are roadmaps potentially to riches if you can read them. How do you learn to read them? Same way you get to Carnegie Hall. Practice, and we provide that for you every day. 10 minutes or less. Stay with us. Be with us. Learn this. It is the most important thing you can do possibly for your financial future because, folks, when the market crashes, you need to know what's going on and get yourself out and not ride it down to ruin. It has continued to move up against all odds. This is an election year, and the market almost always tends to do that. If you read the Stock Trader's Almanac, put out every year. The 2016 version's out right now. It's not too late to get your copy. Yale Hirsch, Jeff Hirsch put it out every year. It is my go-to book. It's my almanac, just like it says, for the stock market. You needed it. Talks about the presidential cycle around page 72, I believe. You need to understand that because we got some tough times coming on that very accurate cycle as soon as this election season is over, and maybe beforehand. October typically can be a rough month in the market. So learn to read these charts. Pay attention. If you do nothing but pay attention to the weekly chart and you can find good entry and exit points, you may be able to protect your nest egg in the future and watch it grow. So please learn this valuable information. We love to hear from you. Again, you want to help us out, go to iTunes, subscribe to the podcast, give us a 5-star rating, helps us with those metrics so we continue to move up in the charts. God bless you. Thanks so much from chartingwealth.com.